What's up? What's up, everybody? Good morning. What a wild start. Well, actually, maybe it was a wild day yesterday. Of course, the Federal Reserve does it again. They show that they have no common sense. They have no clue on how to handle a market, and of course, this is the result you get. You have to understand that inflation. There are two types of inflation, one good, one bad, and of course, the one the Fed is creating is horrible. Their ridiculous target of 2% is rather stupid, is what I would call it. They can't get to 2%, and of course, the creation of the inflation that we're witnessing. If we look at the two different types of inflation, one is when the economy is strong. There's heavy demand, not enough supply. We continue to chase products and buy them. People are making money. They're earning. Everything is good, and everybody is successful, and things are going well, which makes prices go higher. And then, of course, you get the government or the Federal Reserve created inflation, which is really designed to give you a tax. Okay, we went to war for this in 1776, taxation without representation. And you heard your president say when he got elected that he wasn't going to raise taxes. Well, partially he honored that, except that what he didn't tell you is that, for example, importing the gas from Saudi Arabia and from OPEC and from the criminals who are ripping us off, the excise tax on gasoline is bringing in more federal tax dollars because there's federal tax on every gallon of gas that you buy, plus everything else. So the inflation that we're paying now, we can't afford to pay because people aren't working. They're not making enough money. They can't cover their bills. And we've got all these things going on. So what would you think would happen to a market after that? Okay. You can only pop the markets up for so long. Okay. And of course, now we look and we see at the bigger picture, and of course the S&P kind of getting cracked and down pretty hard the last couple of days. Now we're coming down to a support area. And I will say to you now, just be aware of the bounce. If you are not short at this moment, this is not the time to start shorting. Okay. Anytime you make a trade in the market, okay, you must have a reason. So we look and go back to what we talked about, the phases of the market. All right, we are coming down to a potential support area here. Okay. So what you'd really like to do is you would rather see a rally back into, for example, in the S&P, I'd like to see a rally back into, let's say, 44.52 right now. Okay. Now that can change, but certainly if I am not already short, I mean, we've already dropped in the last 4 days or 5 days, 150 S&P points, okay, which is about 4%. So do you want to sell into a market that's already gone down and sold off 4%, or do you want to wait for a rally? Because okay, there is going to be a sharp rally. We call it here at Bubba Trading the rip your face off rally, okay? Because at some point, the shorts are going to cover that are short, and the guys that are going to start chasing him, it's kind of like rats trying to get out of a boat, okay? They're all on top of each other chasing here. And I would just warn you, again, I'm not telling you to buy, okay? Although there may be some reasonable shots to potentially take, okay? But I'm not saying that this is a time to buy. I am saying to you that this is a time to look for a rally that you may want to sell into, okay? Because I think you will find opportunity, okay, to put yourself in a position to sell at a much better level, which would mean you'd also have to take a lot less pressure if you were wrong. Again, one thing we always got to remember is that if I'm wrong, how am I getting out? Okay. So you have to watch and you have to look at these markets and you have to look at them objectively without an opinion. Okay. We know the Fed's ridiculous. We know the Fed has no clue, but none of this is a surprise. They came out with a statement yesterday that rates, although they did not hike yesterday, rates are going to be higher for longer. Well, the markets don't like that. So here you got, again, potentially coming to support. But I think the interesting index to look at right now is the Russell. Now, I do not trade or concern myself with the head and shoulders pattern, but many of you do, okay, that read charts. And here's the classic head and shoulders pattern in the Russell. Here you have what they call the left shoulder. Here's the head, okay, and here's the right shoulder, and then here's the neckline, which has been violated. So that suggests that the Russell's coming down much lower, more likely all the way down to the bottom here. But the next step or the next stop is right about where it's at right now. Okay. And that is something that, of course, too many of us don't take heed from. And so certainly if we come down to here, expect a bounce. Oh, where am I? Lose my mouse. Here we are. Expect a potential bounce off of here. Okay, and then look for a spot to sell. So the logical spot to sell now in the Russell would be about 1826. Okay. Now again, is that going to happen exactly to script? I can't answer that question. I can tell you that you're playing when you're trading and you're doing the things that you're doing, you are playing a probability model. Okay. Everything we do is about probability. Okay. It's not about knowing because nobody knows. Okay. Let's be frank. Nobody knows what's going to happen next. Okay. We can make assumptions. We can determine. I can tell you that I believe the markets are going to sell off at some point 50 to 70%. But can I tell you when that's going to happen? If I told you I could, I'd be a liar. Okay. We know that certain things happen. If you look back in history, and markets are about history. Okay. And unfortunately, the party in power wants to destroy all the history. So we forget how to use history to our advantage. But either you call it the footprint of the market, the map of the market. Okay. At the end of the day, history repeats itself. Now, if you go back and look at 1987, I mean that type of sell-off can never happen again. Because of course they put in so many circuit breakers and so many things to stop that type of free fall. But going into the 1987 collapse, there was a lot of warning signs well ahead of them. Okay, markets just didn't fall down one day; they were going down into that, and that was the culmination. Okay, in 2001, there was plenty of warning signs ahead of time, and then the markets fell. But the one that you most recently remember, 2008, that didn't go down in 2008 in October. Okay, that market was in trouble from late 2007. And again, I'm telling you that there's the same warning signs that are showing up in these markets. And how long do you think it is before panic sets in? Now, again, I am not by any means telling you to short the market here or sell or do anything. I'm telling you to learn to understand what goes on in markets. Okay, understand that you're trading and playing against others. Okay, the trading world is a competition, and you are trading against others. Okay, and if you understand their mental and what they're thinking, then you know that we're only so far away from a meltdown. Now, again, could it be tomorrow, next week, next month, next year? That we don't know. We cannot time that part of the market. But what we do know is that it will be coming, and we want to be able to understand back to the market footprint that is being shown in whatever market you're watching. I mean, you take a look at, for example, Microsoft today. Well, Microsoft is higher right now for the day. Okay. And look at where it's bouncing from. Oh, it went right down to support, tried to break. So you had a little bit of a false breakout to the downside here, and you're getting a little bit of a bounce. It would be no surprise, although certainly the right side or the correct side in Microsoft would be short, but you'd want to find a new spot to sell. So where would that be? Well, maybe 325 is a spot to sell. Apple. Okay, it's pretty flat today. Look at it. It's hovering right on support. Okay. So again, we can see a lot of these things happening based on the price action, the market footprint, and everything that we can possibly look at, that gives us the greatest opportunity for success. Okay. But it goes back to, are you trading or are you investing? Remember, we did our trading plan a little bit on Tuesday. Are you trading or are you investing? If it's an investment, then you shouldn't worry about it, because you're investing in good, solid companies. Okay. And you're not worried about the near term, because you know that the percentage that markets go up 8.5% year over year. But if you're trading, well, then you want to look for, other potential opportunities. Okay. Hold on one second. I gotta see, it's got a beep on something. Gotta see what else is going on here. Okay. We want to be prepared, okay, to do all of these things, okay, based on the footprint that the market's giving us, based on what's happening with, volatility. Okay. Suddenly, as I said the other day, that I thought that by Monday, the VIX would see 18 again. Well, this morning it got up to almost 17. And if this market falls apart again, it could get up to 18. Okay. So if we look at the VIX, what message is the VIX sending us right now? Well, the message is really probably saying that even though we're going down, not panicking down, because if this was a panic down, the VIX would be already up here. Okay, this is more of a steady stream of selling, with some buyers stepping in and trying to take some shots here and there. And again, how do you know that? Well, if you go to the shorter term time frames, here's the NASDAQ. You can see the big push down, okay, and the rally back, and now the actually consolidating action right now. So again, could it break hard from here? Of course it could. Okay, but again, your job as a trader or as an investor is to put yourself in the best position based on what you can watch and what you can see in the market right now. That is, again, what we're watching, and you're seeing these patterns develop and play over time. And if we continue to watch them and let them play, okay, and then try to recognize them and take advantage of what the information that they are giving us, then it allows us the opportunity to be much stronger and much better. Okay. Again, it never guarantees that the next trade is going to be a winner. I mean, in fact, this morning, okay, here, hold on one second. This morning we traded crude, and you can see these lines that we got short. Okay. It went up. We got short again. We never got out of the first because we didn't get stopped out. Okay. Then we got stopped. Then we got short again and had a double position on. And then finally, okay, look what happened. We finally got a little bit of the break, and we're able to, get our money back. Okay. But by doing everything based on probability, it had nothing to do with my opinion. It was all based on statistics, and not, you don't have to go to school for these statistics. These are statistics you're watching the market. Okay. Watching the chart, watching the patterns, and understanding how things happen. And for example, you see these high volume areas with these big explosions. So that, to me, that's either an automatic buy or an automatic sell. Okay. Depending on which way they're going. So they were automatic sells. Okay. And of course, if you manage your capital properly, you have the ability to add on. Okay. And if you add on, okay, when you have the opportunity, it brings your average cost higher and makes it easier to get out and make money on a trade. Okay. And of course, you must, even under any circumstances, still honor the stops that you set. Okay. Again, you must honor the stops that you set. You cannot make exceptions to the decision making or the process that you're using. So when you have a stop and you're setting yourself at a stop, you cannot change your mind. Okay. You are using, hopefully you're learning here that your stops are based on math. Okay. And not based on an opinion. Okay. You have to find a stop. Okay. And I will warn you to never, ever put a stop at a whole number. Okay. For example, if we were going to get in crude oil here, and let's say our stop was supposed to be based on our math and our numbers at 9,100, okay, or $91, you would never put a stop there, because you can bet that at that level there's going to be most likely a shot through that number to make sure. Why? So that the market makers can wipe clean. They call it sweeping the book and taking out the rest of the stops. Okay, because most traders are lazy and will not take the time to gauge and measure where the stop should be, and they don't care that it's around the whole number. In fact, I would make the case that many use the whole number just because it's easy. Okay, versus that you would look at the best way to look for a stop would be to be outside the true range of the move. Okay, so if you were going to put on a stop, okay, so let's use our crude example again. So our first stop on crude, okay, when we got in was at 91.14, okay, and it was, so we were using 60 ticks, for example, above the high of that move. We didn't enter at that price. We entered down here somewhere, okay, let's say at 40 something. But again, my stop has to be based off of either the high or the low of the market movement. Okay, and if that happens to fall at a whole number, then I have to go past the whole number and potentially take a little bit more risk. Okay, so again, we're not trading what the Fed said. The markets are reacting to the Fed. We're reacting to the markets. Okay, we don't react to what is said or news. We react to the way that others react, because what we're trying to do is we want to take advantage of others. Okay, we want to take advantage of emotional traders that put themselves in jeopardy, okay, because they can't take it. And of course, that is exactly what we're doing all the time. We are trying to take ourselves and take our position and say, okay, I'm going to use the market. Okay, I'm going to let the market dictate to me what I should be doing. Okay, and if you continue to do that, you will always be in a much better position, because as we look and go back to the charting, okay, we've got various clues that are in this market. So we can now notice that the NASDAQ is coming out of that consolidation. It is breaking to the downside. So logically, here would be one spot you might be looking at for it to hold, but certainly it wouldn't be a surprise if it came all the way down here. So what would you be doing? Well, if you only want to trade one side of the market, then you would just be looking for a reason to get short. And your reason to get short is certainly not when it's falling straight down. Your reason to get short is to find a rally to sell into. You know, we've heard the terms double tops and double bottoms. Okay, well, double tops work best in a market that is going down. In a downtrending market, you're looking for a rally to sell into. Same as double bottoms work best in a market that is going higher or rallying, that then gives us, again, the potential, okay, for the sell-off or the rally. We want to be with the overall market, but we don't want to chase and buy tops or sell bottoms, because then it forces you to make a decision. And if you're using the right kind of information, you're putting yourself in pretty much jeopardy, okay? Because it forces your stop to be sooner than it should be, because you did not wait for an opportunity or a rally to show up. And I think this is, again, this is a tool that you can use and can remember that will allow you certainly a better opportunity to be that success and create those successful opportunities. Because if not, you're really just fooling yourself, and it's going to be very hard to ever make any money in the world of trading, because you're continuing to put yourself in points of jeopardy. Okay, And that is something that we want to make sure that we always understand, is that we want to stay out of jeopardy as much as we can. Okay. And interesting enough, as I do a daily update every day, and I disclose all of my positions. I've got, whether I've got trading positions on, which I obviously can't disclose, they don't last long enough, but I do have positions that we carry, and we're short. We've been short the Dow, the Russell, and the S&P for a long time, and recently we reversed the Nasdaq to the long side. And some guys, well, I can't trust you more because you're long the Nasdaq. I said, if you can't trust somebody who's telling you the truth of what they're doing and what the chart or the pattern is, then that's your miss. But if you look at the Nasdaq chart, okay, where did it, until maybe today, did it say that it was actually starting to trend lower? I mean, if I look at this, to me, this is still going pretty much sideways. Just because we get too involved and too afraid by the numbers, right? 200 points in Nasdaq. I mean, well, what percentage of the market is 200 points in the Nasdaq? Okay. Well, the Nasdaq's at 1,500, so it's a 1.25%. Okay. And so, let me ask you this question: if you had a stock that was $100 and it went down $1.25, would you be worried about it? Would you be concerned? Would you jump out of it? And the answer is no, you wouldn't. Okay. So again, you have to look at markets in percentage basis, not in dollar basis, because again, the numbers are so much bigger. When I first started trading, the Dow was 800. Okay. So, 10% of 800 was 80. Okay. Now 10% of the market is 3,600. Okay. So again, you have to use what you got. So it's not dollar movement, it is percentage movement. Okay. Don't get caught up in the ridiculous dollar amount of stuff, because you're only going to put yourself in jeopardy because of it. Okay. It really comes down to being that simple. Okay. Because we can't worry. I mean, the chart, if I took one digit off this, and I told you this was 1,500, would it matter? You wouldn't even think about it. So again, don't get caught up in numbers. Don't get caught up in anything else here. I mean, again, this is a chart. It doesn't matter what the pricing mechanism is. I mean, here's a chart that's a $15,000 chart. Here's a $6 chart. Does it matter? Do you know the difference? And the answer is no, you don't. Okay. Here's a $90 chart. Here's a $400 chart. I mean, again, they're all the same. It doesn't matter. All that matters is the dollars or whatever that they're trading. Okay. So you can't put yourself in a position, okay, that is going to create, okay, or put you in jeopardy. Okay. You have to continue to focus in on what is the footprint of the market telling me, what is the chart telling me, and where does that give me the greatest opportunity to be successful. That is what your focuses should be, okay, and on nothing else. Okay. This is exactly what we look at and what we talk about on a regular basis. Okay. And I can't share with you enough that you just have to believe in a process, which goes back to your trading plan. And if you're believing in your process, then you are allowing yourself to be ready for what's going to happen next. Because you can then, if you are looking properly at your markets, okay, then you can say, okay, so I'm looking and I can see that this is going straight down. I have to assume a bounce from here. Now, maybe I say I don't want to buy, which is fine. Okay. Then I need to sit back and wait to sell. I can't just sell here. Even if it turns out that I'd be right, I am guessing that everything is going to be violated versus understanding that there's a higher probability that at least you see your rally back up to, let's say, 438, and maybe that gap will get filled, okay, and give me a reason to sell, okay. That again is always something that needs to be part of our focus is, again, following and managing the market footprint, because at the end of the day, it's always about the market footprint. It's not about the Federal Reserve. As dumb as they are and as bad as they are and what they did, it doesn't matter. You all knew this was going to happen. Okay, markets became overvalued, and I think one of the biggest things to think about is that when 5 years ago, when interest rates were zero and nobody could get anything in CDs, they had the only place to go with your money was the stock market, and now suddenly you can get CDs at 5.5% for 3 months, and nobody wants them. So that's just another. It was just another warning sign that people were ignoring the facts that were in front of them, that there were issues in the market. Because why do places start paying more interest? Because they need more capital. They're willing to pay more money to get it. Okay. And of course, the banks, there are more banks today at the emergency lending window, okay, which is banks borrowing from the Federal Reserve. They call it the emergency lending. There's more money being borrowed, which tells you that our banks are over leveraged. It tells you that the markets are not as strong as they may appear. It tells us that there are issues that are continuing to be a part of this whole situation in the market. And at the end of the day, okay, we have to still do what it is we do. And all it is that we do is we forget about the news. We just look at the price action of the market. Okay, we look at where the chart is, and we make a decision based on that information from a trading standpoint. Okay, we don't. Again, it doesn't matter what stock we pull up here, NVIDIA breaking down. But again, look at where is this the logical support? Just around 400. Okay, the stock's at 414. Okay, right now you're in a range, probably 440 to 400. So at 420, where am I going? Okay, am I going to make some sort of crazy decision based on where that's at? Okay, and the answer is no. I'm not going to do that. I'm going to sit there and I'm going to let the market dictate and wait till it makes its own decision on which direction it's going to go, and then I will either sell it at 440 or potentially buy it at 400. Okay, and if I'm making a trade, then I'm either building a position that is either has a built-in stop, okay, or I'm going to have to set my exit point and honor that exit point, but at the same time also be willing to adjust my stop, not to take more risk, but if it moves in my favor, to take the risk out of the trade. Remember, when you enter a trade, your always objective is to manage the downside, because your money is your inventory. So you want to make sure that your risk is within the correct reason. Right? And now, as it moves in your favor, your first stop move should be to break even. Okay, when you can make that move. Okay, that should be your first stop move, is when you can move to break even. After that, then it's a matter of managing the profit, managing the price action of the trade. Okay, and putting yourself, again, all you can really do is create situations that are high probability for yourself. Okay, you cannot do anything else. It's everything we do is about probability. And again, I go back to again the chart, and I look at the chart and I go, so what is the probability of the S&P? Well, the probability is that, as we've been talking, it's continuing to come down towards that support. So what would I expect from here? And probably expectations should be that they may try to push through, but at the end of the day, my expectation should be that there'll probably be a little bit of a potential spike rally from there, okay, or the old what you call rip your face off type rally, okay, and that should be your focus, okay, not anything else, okay. Again, you're trying to manage and put yourself in a position at all times of the best opportunity. Now, again, the best opportunity does not assure that you're going to make money. Okay. But if you continue to always keep yourself in the best spot, then you're going to be ready for what happens next, and you'll be able to accept the loss. Okay, well, because again, they're not all trades aren't going to be winners, but we do have things that we're watching, and again, whether we're watching the euro currency, okay, and where's the euro currency? Well, the euro currency should come back down to somewhere in this neighborhood, right? So again, I urge you to remember, okay, that we have to be in position at all times to follow the market footprint and be prepared for what that's going to bring to us. Okay, because that is as simple as it gets. Is the footprint itself? The footprint itself is something that we have to be always prepared for. Okay. And again, it's no different than if you're looking at silver. I mean, again, silver came right down to support. And look at the bounce. Okay. And again, none of this is pre-planned. This is all live right now that we're looking at together. Okay. And I want you to recognize that it's all live. Okay. And I want you to recognize that we can't make changes or trades that we can see the bonds. The bonds have now broken down again. So would you want to be a straight seller in the bond market right now, or would you be waiting for a rally and looking to sell it back if it would ride back to 117.25? Okay. And your answer should be that you'd be waiting for a rally to sell it, okay, back at that point. Okay. And if it doesn't get there or if it doesn't do what you expect, the market will create other levels. Okay. The market will create other potential opportunities, and you have to recognize those and then be willing to readjust your thinking. Okay. And if you do readjust your thinking, okay, then you're suddenly being put into a better position. Again, it doesn't matter what we're looking at. Okay, here we are. The soybeans. Again, we've looked at a stock. We've looked at a future, and now we're looking at a commodity. It doesn't matter. The charts are the same. I'm looking at the same thing. I would expect a bounce from here potentially. Again, I'm not going to buy for the bounce because I know that the trend is lower, so I'm looking to be a seller. However, okay, if it breaks through and comes down and tests this level here, then I'll want to be a seller here. Or if I get a rally from here, I'd probably want to be a seller about, let's say 1326. It doesn't matter. The numbers are not important. Nothing is important here with the one exception of where's the chart, where's the price action, and where am I going to go from here? Okay. And that is something that, again, no matter where I go to, Bitcoin, okay, continues to be stuck in a consolidation phase. Okay. Today it's selling off a little bit. Okay. Again, it doesn't matter. I would say to any of it. It shouldn't matter to anybody. Okay. Your opinion, you may have an opinion, but your opinion should never come into play in the market. Okay. Your whole opinion should be based on what you're reading right here. Okay. Whether they be illiquid stuff here. Here's orange juice. You can't really trade this, but it's a market. Okay. But again, what's the trend? What is, think about it from a standpoint is what is the path of least resistance? Okay. What is the path of least resistance is the way that you should look at it. Okay. And if you continue to look at it that way, okay, what is the path of least resistance? It allows you the understanding, the opportunity to benefit from the path of least resistance. Okay. And that is something that, once again, we have to be constantly and ready, prepared for. Okay. Because it's all about what we can read within the charting path. Okay. Coin, another one, just stuck right at the bottom of consolidation in a downtrend. So what would be my path of least resistance? Again, the path of least resistance is still down, but at some point there's going to be a potential bounce here. Okay. And if that bounce shows up, I want to be prepared for it. Okay. And I want to be ready to sell it because that is the side of the market I'm looking to get to. But I'm not going to chase the market down now because that's what my opinion is. Okay. My opinion cannot play into the market here. Okay. My opinion cannot play into it. I have to let the actual geometric progression of the markets tell me what to do. Okay. I cannot look for anything else. I must purely be without opinion and purely be straight up and straightforward looking for these markets. Okay. And looking for what the signals that the markets are sending. Okay. And as we're talking, and notice we came down to support. Oops, let me get you over here. And we came down to support and we popped in the NASDAQ. We came down to support in the Dow. We're popping a little bit here. Here, they're all doing exactly what you would have expected. And again, you're not everything you see is going to make money, but everything you see is going to give you and help give you a plan, okay, to be able to move forward and do better, which is at the end of the day, all you can possibly do is to be prepared to move forward and go better, okay? And that is something that we watch because you start to see general directions, okay? Now, basically, if I were looking, here at the Russell, for example, on a short-term chart, I might look to be a seller here. In the S&P, I might look to be a seller here. Okay, now I'm not trading them live right now, but that is a quick view of the footprint. And of course, if I look at the euro currency, there's nothing for me to do here. This is in very, very tight consolidation. So that's what I have to be, and I have to be focused on. So, I know we're covering a lot of ground. Ruben, are you here? So that's what we always have to be focused on, okay, is to understand where we are within the markets. Okay, I'm gonna cut out in a couple minutes, okay, babe? Just want to make sure that you were here. Okay, so we just have to understand what we're looking for, what we're trying to accomplish, okay, and we can see that crude is probably got a chance to now come down to probably in this area here, okay, but here is some support, so don't be surprised if there's a little bit of a bounce from here, and at some point you're going to get a spike like you here. This was earlier today. So if I can have one show here. Wait, let me go to the bigger chart. Go here. And I want to change the time. Okay, here. This was the opening this morning. Okay. Look at the straight up spike. Okay. And then, of course, it came right back down. So if you're prepared for that, again, that would have been an opportunity to potentially sell it. Now, again, it goes back to recognition, the chart, the footprint, and making a decision and using an exit to make sure that you're getting out. And if you don't do that, then you're not going to have a chance to make any money. That is really more what it comes down to is your willingness to let the markets dictate what they're going to do to you and how you're going to handle how the markets are going to work with you. If you don't do that, then you're not going to make any money. And as always, sorry, I got to cut it short, but it's pretty busy, so I got to go make some money. I appreciate your time. I appreciate you being here. And remember, don't forget to subscribe below. And Ruben and Max, thanks for your help. I appreciate you, and I'll see you guys back here on Tuesday. Have a great day, everybody. We'll see you later.